Hey everyone, Tony Mello, Mello Properties team. Hope you're all doing well. 508-369-9755. Continuing with my little videos of financial terms as I read here. I'm going to go through some of these and kind of just pick out certain ones that are ones that you might come across more frequently than some of the other ones that you wouldn't. Note. There's a difference between the note and the mortgage. I did a video previously to this one that kind of went into that. Note is, in this case here, an IOU given to the bank by the borrower. Note is the document that shows, that provides evidence that you owe them. The mortgage is the security, so that if you do not make good on the note, don't pay on that note, your mortgage is the document that says the bank can take your house from you, sell it, and take their money back. So differences between the note and the mortgage. Open-end mortgage, package mortgage, piggyback loan, PITI. I did that in a previous video as well. Principal, interest, taxes, and insurance. Once you've pinpointed a property, you'll know the taxes and insurance. They'll be able to give you the principal, interest, taxes, and insurance, the full mortgage payment, more or less, the full mortgage payment that you should expect per month, every month going forward. Points. A charge by the lending institution to borrow money based on the loan amount, not the purchase amount, but the loan amount, paid along with closing costs. Buyer is charged, can be negotiated 1% of the loan. Could be 1%, could be 2%, could be 3%. Again, they say it's negotiated, but when the lender says this is what we need, this is what we need, you can try to negotiate. I've never actually had a situation where the bank said it's got to be this, and we're going, you know what? Give you half of that. Try it, but I've never seen it be successful. So that's what points are. You're paying for the benefit of getting something at a reduced rate. And again, in some of the other videos, I was talking about weighing the differences between what you're paying now, what you would have paid if you didn't pay the point, and compare those two differences to make sure that you know what either one of those two is really doing for you, and at what point is break even and start making money. If it's too far out into the future, you might not want to do that. If you start making money on your money closer to the time that you purchase the house, then maybe you do want to do that. So I've never done that calculation. I may chase something down, see if I can figure out, how that works, and with maybe clients or something, how that could have possibly gone. And it's not something, again, that I would do. I'm not a lender, I'm a real estate agent, but curious to see how that would work. Pre-approval letter. Important. I'll go into this definitely. So as a real estate agent, people come to me and they say, I want to see that house. And that's great. That's what I want, so that I can start helping people buy homes and eventually get to a closing and make some money. Pre-approval letter, notification from a lender that a buyer has been approved, approved before buying something, getting to a closing, pre-approved for a loan if certain conditions are met. So pre-approval, it's important. It's important that a buyer go to a lender, any lender at this point in time, or go find your favorite lender. If you've got a banking relationship with somebody, go to that bank. We have lenders that we use pretty consistently. So they deliver. We can send you to those folks, and they can give you a pre-approval. There is a difference between pre-qualification and a pre-approval. A pre-qualification is one where they ask you, how much do you make a year, or whatever it is, and you give them a number. I make $100,000 a year. How much do you think your credit score is? I have a credit score of 750. Boom, done. Here's your pre-qualification. Which is all great and dandy, as long as when they go and check that stuff to make sure that the credit score and the income is there, that it is what it is that you said it was, that it hasn't changed. So by the time they go and check that, if it is not what you told them it was, that pre-qualification is useless. They're basically going to say, oh, I'm sorry, You know, you told me it was 650. You told me you made $100,000. You make half of all of that. You know what I mean? That will create you problems because by that time, now we're talking pre-qualifications. By that time, we've submitted an offer. We've given somebody, a listing agent, your pre-qualification. We've given them your deposit money. We've given them your offer. We've gone and seen the property. We've done work as far as putting paperwork together. They've agreed to your offer. Again, you can see where I'm going with this, that the problem is when the lender goes and actually does the work and looks at your information and now discovers something potentially, and this has happened before to me, actually a couple times now, that we are now invested in an offer and with your money tied potentially within their grasp of them keeping a keeping that deposit money. So a pre-qualification is what it is. Some banks say that's all we do, that we don't do anything else. Some of them try to muddle the difference between, oh, a pre-qualification and a pre-approval is the same thing, and we do a pre-qualification and we run all the numbers. I don't care what they call it, to be honest with you. They call it a pre-qual, call it a pre-approval. How much work did you do to qualify this person to make sure that by the time we get into something, the chances of our success is higher? That is the thing. So that's in general. Pre-qualification is that. You gave them some verbal information. They threw you a piece of paper saying, yeah, roughly this is what we'll lend to you. A pre-approval, in general, is a little bit more advanced than the pre-qualification. A pre-approval, they'll actually pull, they should at least, pull pay stubs, W-2, the paperwork, at least some of the paperwork, so they can look at it, put it through their underwriting. They've got a computerized underwriting thing at that point in time instead of an actual person in the back office. You know, and that's computerized, excuse me, underwriting thing spits out, and once they put the information in there saying, yeah, I saw the W-2s, I saw the pay stubs, and they do make this, I pulled their credits, you know, and they have a credit score of that, and it'll shoot out, all right, here's the number that we think we can give them. That is more secure. That is a better document, gives the real estate agent more confidence, not just on the buyer side, but on the listing side. So your offer becomes a stronger offer with a pre-approval as opposed to a pre-qualification. So that's a key point too. If you've got two competitions, you and somebody else, and one has a pre-qualification letter, a pre-qual, and one has a pre-approval letter, the listing agent, if they've got some experience in this stuff, will go, this one is a better one. The chances of this one happening are 80%. This one is 30%. They're going to go with the one that has an 80% chance of success in getting to a closing. So pre-qualification, pre-approval. In addition to that, and again, they all have different little terms for it. Some of these folks will call it a fully underwritten pre-approval. So 3 levels. Pre-qual, at the bottom of the barrel. Pre-approval, more or less standard. A fully underwritten pre-approval. Fully underwritten pre-approval, basically what they do there is they collect more paperwork. They do more on the front end so that by the time you get to an offer stage, at least, the chances of surprises popping up with a underwritten pre-approval is less than. So that's the kind of thing. This is at 9 minutes. I'm not going any further than that. Pre-qualification, pre-approval, okay. Fully underwritten pre-approval, beautiful. Lenders don't want to do that because it takes time, it takes work, and if they do that for you and you decide that you go with some other lender, they just did all that work for nothing. It's part of the business. Happens with lenders, happens with real estate agents all the time, where we do work and sometimes it just dissipates, goes away, or goes to someone else that takes the benefit of the work that you had done. So they don't like doing the fully underwritten pre-approval. They prefer the pre-qualification. How much? Yeah, fine, here you go, here's the number, take it. If you lied to me, it's on you, you know. So that's the kind of the deal, you know, with that. Tony Mello, Mello Properties team, 508-369-9755, just under 10 minutes. Have a good night.